The 2013 Examcraft, just do the workings first of all. I'll probably do the rest of it later. Okay, so working 1, nothing to do with that. Working 2, goodwill written off. So we've got the goodwill at cost is 120,000 and it's written off over 10 years. So that's 12,000 a year. So you always use the at cost figure. So then the value of goodwill for the balance sheet will be its value, 72 minus the 12,000. So its value is 60,000. All right. No record has been made in the books for goods in transit costing 18,000, and we've received the invoice. So that is stock has to go up, purchases and creditors. It's stock of raw materials. So you own the goods, but they haven't arrived yet. That's the reason stock changes. So it's your closing stock of raw materials starts off as 58, and we're going to add on the cost price, 18,000 to that. We're going to add on purchases of raw materials, cost price, which is 450 plus 18. And then we'll have creditors, which we're going to have to add on as well. So 89.1 plus 18. So that's working 3 done. Working 4, it's the new factory. So during the year, an extension was added to the factory. The work was carried out by the company's own employees. The cost of labour is included in factory wages. So we'll take it out of factory wages. So direct factory wage is 178, and we're going to take out that 26.4. And we're going to add it to our buildings at cost. So land and buildings cost 800,000. We're going to add in that 26.4. Alright, we're going to take out the materials then, so that's purchases of raw materials. That has to get taken away, 24,000. And we're going to add that into buildings. I'll just check who arrived later. Jack, are you alright? You're bloody late. I'll stick you in a room here, hold on.
Hello?
You're ruining my video, Jack. I'll put you in a room now. Get here on time, okay?
Yeah, sorry about that.
What's after happening there? Hold on. I'm in the middle of recording a video here, Jack. You're about to be a star. Alright, I'll see you in a while.
Yeah, thanks.
Alright, sorry about that. So 26.4 plus 24,000. They get added in to the buildings. Okay, so that's number 4. Number 5, goods which cost the firm 12,000 to produce were sale or return. So that's sales and debtors have to go down, and stock of finished goods has to go up. So stock finished goods is 75,000, and that goes up by the cost price. So in this question, the cost price is 12,000, so that gets added in, and then the sales goes down by the selling price. So sales is 875, and we're going to have to take away the selling price. So the selling price is 12,000 plus 25%, so that's 15,000. Okay, and debtors will go down by 15,000 as well. Okay, so that's our That's our goods in transit one. Number 6, then the suspense is discount received entered only in the discount account. So a discount received, you get a discount off creditors. Okay. So just answer this. So you get a discount off creditors. I'll just see who this is getting in here. Hold on. Killian, you alright? Okay, Killian? Jack?
Yeah, sorry, I'm not sure what was happening there.
Yeah, I'm going to put you in a room now. Alright, I'm just in the middle of making a video, so I'll do it very quickly. Hold on.
Cheers.
Save. There you go. Hold on. Perfect. Alright, so sorry about that. So you receive a discount from creditors. So creditors should go down. So it's 89.1, and we already have creditors somewhere, I think. So creditors go down by 400. So now the credit side is 400 less than the debit. So whatever incorporates suspense has to go down as well. So general expenses, they're going down by 400. You all right?
Can you put me back into the? Oh yeah, there it is. It was just I didn't have the laptop yet. I was in my stepdad's room, so I just got it there. I was on my phone.
All right, you sorted?
Yeah.
You're starring in my video. Grant. All right, see you in a while. So that 400 gets taken away from general expenses because the right hand side went down, so therefore the left hand side has to go down as well. All right, we're going to split those up 75%, 25%, so we'll do that at the end. Number 8 then, a full year's depreciation on fixed assets is provided as follows: plant and machinery 10% of cost, buildings 2% of cost, land which had cost 300,000, it was decided to revalue land and buildings to 1.2 million. So I'm going to do the depreciation of the land and buildings first. So it's 2% of the new land and buildings figure. So in this case, it's what's that? 850,400. So 850,400, but you have to take away the land, and the land element is 300,000. So it's 2% of 550,400. Which is 11,008, which seems like a bizarre figure. So we'll go with it. I'm going to check the marking scheme in a second. Not that I don't have faith in myself. Where is it? Yeah, 11,008. All right. Now instead of we're revaluing, so instead of so we'll just put our land and buildings at a revalued amount. So they're being revalued to 1.2 million. So from 850 up to 1.2 million is going to be a revaluation. What will that be? So it'd start off as 1.2 million minus 850,400. So it starts off 349,600. And we have to add on the 11,008, and then we have to add on the depreciation to date, and that'll give us the revaluation reserve. So the accumulated depreciation to date on land and buildings is 40,000. So that'll be 349,600 plus 11,008 plus 40,000. That's 400,608. Now the depreciation of the machinery I'm going to do in conjunction with working 10, right? So I'll just do what machinery is first. So machinery, it started off at, plant machinery started off at 450, but then we sold machinery costing 40,000, so that's down to 410, and it tells us its policy to charge a full year's depreciation in the year of acquisition, but none in disposal. So the depreciation of machinery is just going to be 10% of the 410. It's for a full year, so it's 41,000. Now, so we have to work out the accumulated depreciation on the one we sold. Now we're only using this as a working. So you got it in May 2010, and it's a full year's depreciation in the year of acquisition. So it doesn't matter that you bought it in May. It's as if you bought it on the 1st of January. So you have it for all of 10 and all of 11. But then you have it for 12. Now you sold it in November, but you're not depreciating it for any of November or for any of 2012. So it's only 10 and 11. So it's going to be 10% of the 40,000 by 2 years, which would be 8,000. Okay, so that's the depreciation on the one we sold. So therefore, the accumulated depreciation in total will be what we start off with, 140 plus the 40,000, or 41,000, minus the 8,000. So the accumulated depreciation will be 173. All right. Now, as always, then you'll work out the profit or loss on the one you sold. So its value was 40,000 minus 8,000, which is 32,000, and we received a check for 24,000. No, where is it? Sorry. We received a check for 28,500. So therefore we made a loss of 3,500. And that's in manufacturing overheads. Alright, so we made a loss on the sale of a van of 3,500. And then the check, so the check was left in the drawer for 6 weeks and it wasn't lodged to the bank. So it should go into the bank. So we go up and have a look at the bank and we'll see that it is a debit of 59,1. So it's money in the bank, 59,1. And then we received the check for 28,500. So we're going to add that up. So your bank is going to be 87,600. All right, so that's that one done. Debenture interest due at the end of the year. So we'll obviously work out our debenture interest first. So we'll go up and have a look. So there's 8% debentures. So it's 8% of 200, but you got 50,000 on the first of the 6th. So it's 8% of 150 by 6/12, and then 8% of 200,000 by 6/12. All right. Okay, so that's 14,000 in total, and of that, check how much you've paid. So should have paid some debenture interest, I would think. You paid 10,000, so the debenture interest due will be 14,000 minus 10,000, which is 4,000. So in your balance sheet, it's going in as 4,000. And then it asks us to work corporation tax, so just make a note of that, right? the corporation tax is 43,000 and it's due, which makes it also a current liability. So I'm just going to go back up and split up my general expenses. So my general expenses that I've worked out are 58.4. So, and 75% of that is going to be a factory overhead, and 25% is going to be admin. So we'll just split it up that way, and the same then for our depreciation of buildings, which was the 11,000 and it was 11,000 and 11,008 or something, was it? So 11,008, and again factory overhead is 25%. So 75%, and then the difference is admin. Alright, so we'll just go through where everything goes. That's all of our workings done. I hope they're right. I obviously went through them fairly quickly. I presume they are. We'll go through where everything goes. So goodwill is a fixed asset. Goodwill written off will be admin. Stocks of raw materials, so they're closing stocks, so it's obviously raw materials, so it's manufacturing, and it's also the current assets. Purchases of raw materials is manufacturing. Creditors are current liability. Factory wages is manufacturing as a prime cost. Buildings, that's factory buildings, it's a fixed asset. Sales is obviously in the trading. Debtors, current asset. Stock of finished goods is trading and a current asset. General expenses, so that was being split up. So we're going to come back to those. Land and buildings is, just with that one we revalued it, so it's this land and buildings we're putting in, so that's a fixed asset. The revaluation reserve is financed by. Machinery is a fixed asset. Depreciation of machinery is going to be a factory overhead in the manufacturing. The accumulated depreciation, well, that will go in the fixed assets as a minus. Or that doesn't go in at all. The accumulated depreciation is a fixed asset as a minus. The profit or loss, so it's manufacturing, so it's a loss, so it's a factory overhead. Bank's a current asset because it was debit. Debenture interest goes into normal spot. Debenture interest due is a current liability. Corporation tax has a spot in the trading as well. It's both the trading profit and loss account. And it's also then a current liability because it's due. And then your general, some of it is factory overhead, some is admin, and the same with the depreciation. So everything left then, so your opening stocks, finished goods in the trading account and the other two into the manufacturing. Goodwill we've done, admin goes in admin, selling goes in selling. Sale of scrap material, so that's an that's taken away in your manufacturing account. Your share capital in the finance by. Profit and loss is a credit, so that's a plus in the profit and loss account in the trading. Bank we've done, general expenses we've done, discount net, it's a debit, so that's a selling expense. Direct factory wages we've changed, debtors, creditors, purchases, nothing to do with debenture interest paid. VAT is a debit, which makes it a current asset. Debentures, current finance by. Land and buildings have changed, depreciation have changed, plant and machinery have changed, accumulated depreciation and sales, they're all changed. So interim dividends for 6 months is 36.6, and that goes into your trading profit and loss account. I wonder, are they looking for dividends due to be declared? They're not saying there, but that 36.6 goes in your trading profit and loss account. There is, I suppose, some dividend due there. There is a dividend due. I'm going to have to check the marketing scheme and see if they throw it in. Because there's not. We don't know if there's a dividends due, so we can assume we can leave it out. So that's everything, lads. We will correct the rest of it in class.